Okay, so now that we've learned about the different types of costs that manufacturing companies incur, we can look at the calculation for their cost of goods manufactured, cost of their manufactured goods. Excuse me. Okay, so here's a basic income statement for a manufacturing company. Now, it is by far the most complicated between merchandisers, manufacturers, and service companies. So the income statement for a manufacturer will be more detailed. It contains a lot more information. And we start up here. It looks the same as a merchandiser. Sales revenue minus any sales returns and allowances minus sales discounts gets us net sales. Then we have a section for cost of goods sold. And on the next slide, I'm going to show you how we actually calculate that cost of goods sold. So your net sales minus cost of goods sold is going to give us gross profit, if you remember from your financial days. And then we have our selling and administrative expenses listed out here. Now, remember, selling and administrative expenses are our period costs, and cost of goods sold is going to be a product cost. Once we subtract those, we get operating income. In this case, we had other expenses, which was interest, to get our net income. So in calculating cost of goods sold between a merchandiser and a manufacturer, let's take a closer look. So for a merchandiser, the formula begins with the beginning balance in the merchandise inventory account. And to that, we're going to add purchases and freight in, and then the sum is the cost of goods available for sale. That's what we have in total available for sale during the period. And then to compute the cost of goods sold, we subtract the ending balance in the merchandise inventory. So say we go out and we do a physical inventory count, we'll subtract that to get actual cost of goods sold. Now, a manufacturer's calculation differs ever so slightly, which you can see here. We start with the beginning balance and finished goods inventory. Those are goods that are ready for sale. They are complete. And then the next step is to add what we call cost of goods manufactured. That's going to give us our cost of goods available for sale, subtract ending finished goods inventory to arrive at cost of goods sold. Now you're probably wondering, how do we calculate this cost of goods manufactured? So I have that here on the next slide. And the way we do that is we start with our beginning work in process inventory, and then we add direct materials, direct labor, and manufacturing overhead. So remember that direct material, direct labor, and manufacturing overhead, these were our total manufacturing costs. And then we subtract our ending work in process inventory. That gives us cost of goods manufactured. Okay. So here's an example of an actual cost of goods manufactured. You can see it gets a little complicated. So the total manufacturing costs incurred were $607,000, which you can see down here. If I can get my pen to work. Which you can see down here, $607,000. And then the sum of that's the sum of $355,000 of direct materials used, the $169,000 of direct labor, and the $83,000 of manufacturing overhead. So we started with our beginning work in process inventory, that's $80,000, added our direct materials, direct labor, manufacturing overhead to get our total manufacturing costs incurred during the year of 607. Once we have that, then we can subtract our ending work in process, which was $27,000, to get cost of goods manufactured of $660,000. Now let me just point out as well, and I know it's a little bit hard to see, but direct materials used was calculated by taking our beginning raw materials inventory, adding any purchases. That gave us raw materials available for sale. Then we subtract our ending raw materials inventory to get the direct materials used. And manufacturing overhead was our indirect materials, indirect labor, and in this case we had depreciation and utilities and insurance and property taxes to get total manufacturing overhead. Now the balance sheets also differ between service, merchandising, and manufacturing companies, but they're not quite as drastic as the income statement. So you can see service companies don't carry inventory under their asset section. Merchandising companies would have one category of inventory, and then a manufacturing company would have raw materials inventory, work in process inventory, and finished goods. And also, let me just point out to you here as well. So this is an example of an external financial report, and we're not showing all the detail. If it were an internal report, the merchandising company manufacturing inventory would list out what all those inventories are to compile the $2,200. Okay, this is just another graph that kind of walks you through the flow from product to period cost. So we start out here with raw materials inventory, and that's raw materials plus any freight charges or any costs getting the inventory ready. And then it flows into work in process inventory, and there's journal entries required to move it from raw materials into work in process. And in work in process is where we actually add the labor and manufacturing overhead to convert that material into finished goods. So it flows, once it's finished, from work in process into finished goods, and again, related entries associated with that. Once it's finished and we sell it, it moves into cost of goods sold. So there it goes from our balance sheet to our income statement, where we take our revenue minus our expenses to get gross profit, and minus our selling and administrative to get operating income. And one more time, cost of goods sold is a product cost, whereas selling and administrative expenses are going to be period costs. Okay, so in general, for each inventory account, we've got a nice little graph here that shows you the flow of cost through those different accounts. We're going to start with the beginning balance, and then each account has items which are going to be added to the beginning balance, and then the ending balance is subtracted to determine the amount that has been used or sold. So let's start and look specifically at raw materials inventory. So we start with our beginning balance, and then we add in purchases or freight, and then we subtract the ending inventory balance, and that will tell us how much direct materials were actually used. And then the cost of those direct materials flows into our work in process inventory account, and that gets added to the beginning balance. Beginning inventory that was there from the previous period. We add those direct materials that are used, plus any direct labor and manufacturing overhead that we've encountered. And then we subtract our ending inventory, ending work in process inventory, to get cost of goods manufactured. And then finally, that cost of goods manufactured flows into our finished goods inventory. Again, start with the beginning finished goods inventory, add the cost of goods manufactured, and subtract ending inventory to get cost of goods sold.